A very good morning from Hong Kong, where it's 9 a.m. here in the city. It's also 9 a.m. in Beijing and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles. Let's get to your top stories today. Equities across the region down. That's as Fed minutes show. Policymakers seeing rates staying higher for some time. Tech stocks are taking currently the biggest hits. Now, oil is extending gains this part of the world here following supply disruptions in Libya. You have blasts in Iran killing nearly 100 people, adding to tensions in the Middle East. And a Bloomberg scoop. ByteDance said to be eyeing Amazon's home turf with plans for a massive expansion of TikTok's e-commerce business in the U.S. Welcome to the program. Hope you're all well. We'll get to all those stories in just a moment, but certainly the flavor of these markets remains unchanged from this time yesterday. There's still a risk-off tone across risk assets in this part of the world. We are getting, of course, incrementally more declines because Japan is coming back online first time in 2024 following, if you follow at least measured on the Nikkei 225, the best year for Japanese equities going back about 10 years. We're down 1.6% on the Nikkei 225. You obviously have, well, for one, catch down. And obviously, number two, given the twin tragedies we have seen, of course, in Japan so far this year, muted on A50 futures. We could see a third day of declines still across Chinese equities today. We'll see what happens, of course. Flip the boards, please, if we can. So we talked about tech, sort of the growth-oriented benchmarks in the regions. And the Kospi took an absolute kicking yesterday. We're still continuing to see some of that follow through in today's session. We have three markets coming online. In Taiwan, of course, that is also a very tech-heavy benchmark right now. Bit of a bounce in the early goings, opening minutes. Let's give this a few more minutes, of course, to really get warmed up. Now, the currency markets, a stronger dollar still in most cases as we look ahead to today. Of course, as you can see, the Aussie dollar is on the weaker side of the cutoff today. Dollar yen is slightly lower. Well, let's call it flat right now. And of course, we're watching the VIX following what was really a strong one yesterday relative to estimates. So we'll see what that holds today, of course. Flip the boards, please. Bond markets, 2, 5, 10s, and 30s. The Fed minutes, of course, with a big story out overnight. You also have some employment numbers coming through as well. We'll talk more about the Fed minutes in just a moment. And of course, commodity markets where it's still energy. So you have Brent, West Texas. You have oil coming online in Shanghai playing some catch up there, 1.4%. So you have tensions. You have what happened in Iran, the blasts there. On top of that, we're getting more details now on some of these disruptions that we're seeing over in Libya. So we're talking, give or take, last I checked, I think it was 70,000 barrels a day on that specific oil field, over in Libya. Right, now let's talk about where we are market-wise, perhaps take a half a step back. Our folks at Bloomberg Intelligence this is a fantastic indicator, perhaps leading indicator of where stocks go. Going into the end of the year, and perhaps reason why we're seeing some weakness right now, the market pulse index actually hit a manic level. The last time we were at this level was back in July, and then we saw a 10% decline in stocks following that, us hitting that threshold. Now, that being said, that might mean slower forward returns in the next 3 months or so. That might mean S&P outperforms Russell. That might mean some of your low-vol stocks will continue to, perhaps the best place to be if you're in equity markets. But suffice to say, this is an indicator you want to watch. It's a monthly indicator. We're there going into this year. Now, that takes us into the conversation around the Fed and perhaps what did lead to the rally from about October here. Morgan Stanley's executive chairman and former CEO is actually among those expecting the Fed to cut rates this year. We spoke exclusively to James Gorman, and here's some of what he had to say.
First half of the year, I suspect nothing. Back half of the year, they could easily move a couple of times. We started this journey with inflation at 10%, rates at 0, unemployment at 3.5%. And my objective was to get us to 4, 4, and 4. 4% inflation, 4% rates, 4% unemployment. We're about 3% inflation, we're 5%, 5.5% in rates, and we're about 3.5% in unemployment. So rates will come down.
From that take, Let's get the hot take now also from our folks at Bloomberg Economics on the back of the Fed minutes out overnight. So we know about rates. We've talked about that a lot. There's also additional dovish signals, they say, because they've started to talking about slowing the pace of quantitative tightening. What does that all mean for risk assets? Can we believe the signals coming out of these markets? Let's bring in Ben Emmons, Senior PM and head of FI and macro strategy at New Edge Wealth, joining us out of New York today. Ben, well, first and foremost, Happy New Year. Nice to see you, sir. Let's start with the minutes, if you don't mind. Well, these were from the last meeting, which was early-ish part of December. So my first question there would be, what parts of the minutes do you think are still relevant, and what can we largely, I guess, in many ways overlook at this point, given that we have had new commentary following that meeting of the Fed?
Yeah, I think, David, that the part about the discussion of the rate cut projection was, I think, the attention by the markets for the most of part of it, because what Powell said in that press conference, I think, was really highlighting that part of the discussion. They're going over their projections. They're having every one of them their own opinion about it, and all looking in the future of, like, we keep rates still high here for some time, so that higher for longer narrative is a little bit back in these minutes. But that's not really relevant anymore. It's more about what's the next step from here. Now, they don't give any timing, obviously, but they do highlight that they were discussing it. So I think getting that confirmation, that will probably help markets a little bit in the morning session. I think tomorrow morning, and see the S&P futures up a little bit. That seems to be indicating that there's some relief on the back of these minutes. So I think this is the relevant part, and the rest is more about what data will tell us from here. And obviously, we're going to get payrolls on Friday, which will be the first big test to the market of, okay, if that's strong data, then the Fed can stay on hold. If not, then this rate cut will become sooner in sight.
To your point, Ben, it seems, based on pricing at least, markets are treating March as if that's a done deal. Is there anything between now and March, you mentioned the jobs number, that perhaps removes a base case cut for March off the table, Ben?
Well, first and foremost is the CPI data, because that's key in the wake of the core PCE deflator. And this time, I think, David, is maybe even a bigger event than before, because that core PCE deflator did show that there was a deflationary pressure building in the index. Not just a few categories, but more categories are in deflation now for the last 6 months or so. I think we want to, if you're going to see that in the CPI data, then that's going to be really key for the timing of the rate cut in March. Because one thing that Powell did say that was not showing up in these minutes was that, if they waited too long with rate cuts and inflation was going down further and they're sitting there waiting for it to hit the target, they feel that it may be too late and therefore have to take action. I think if inflation data gets softer from here, then the market may be right that eventually March will be the meeting that the rate cut could happen. So it's very key that CPI data.
Okay, so we talked about the timing of the first one. Let's talk about, Ben, the magnitude of the cuts that we'll likely see this year. I mean, I think the FOMC, meets 8 times this year. Let's call it, if they start in March, that's almost a cut at every meeting. Do you get a sense that the trade right now is to fade all these dovish bets, or do you think there's even the possibility that markets can even price in further cuts than already that exist on this market table at this point?
So my first thought is that you would actually fade it, because at every meeting a cut, that would definitely mean that we're suddenly turning from this economy, from the 2.5% that we apparently are now, from the GDP now data you can tell, right into recession, right? That you would see rapid cuts coming through, because every meeting, that would be a lot, I think. So you would fade that. But if, as I mentioned, if we're progressing in the year and we see more and more downward pressure on inflation developing, then at least you could see that the Fed may take several meetings of bringing rate cuts to the market. So I think that this is, really driven by inflation data in particular. But every meeting, that seems to be, unlikely unless the economy really shifts downward.
Yeah, hopefully that's not the case, and hopefully they do stick to that soft landing that most people expect Your view on risk assets, I think the full year is a bit too much. The first quarter, would you buy this dip in equity markets, within equities? Is it value or growth? And also since, let's put your fixed income hat on, Ben, as well. Treasuries, high yield, investment grade, where do I want to be?
I think to start with risk assets, it's interesting to see the rotation continuing. Before the holiday, it was all about small caps, and you saw the Max 7 tech stocks trading off a bit. But now you're seeing utilities, healthcare, financials, and even real estate, and to a lesser degree energy, being really taking on leadership of the markets. And I think this is the key theme for the first quarter, that the tech sector has lost the leadership, and likely more real estate and utilities are taking on the leadership. So that's, I think, the initial trade. And that is risk on, because as much as those are defensive sectors, it is about getting out of these really overvalued tech stocks into something more undervalued. And that's definitely the case for utilities, for example. It trades at less than 10 times forward earnings, right? And so that's, I think, an idea of risk on, like people want to put their money to work in something that's undervalued. Now, if you take it to the bond market, so we're sitting here just below 4%. I do think that yields are maybe somewhat on the lower side, because as we talked about, these rate cuts, they won't likely happen at every meeting. And this 6 rate cuts have been priced in. That's probably not going to be met entirely either. So some of that will be taken back. It would mean the treasury yield will go up a little bit, I think towards 4.25 or so. But I'm not sure if you're going to get all the way to 5%. So fixed income remains, I think, an interesting play here for this year, in the wake of also that inflation is likely to moderate unless there's a shock out of the Middle East. So I think investment grade and treasury still are a good alternative to these defensive risk-on sectors like utilities and energy and healthcare.
Okay, would the risk-on theme apply to China? What do you think about this massive part of the EM complex and the risk premium that has, I don't know what the right term is, has calcified around this, the world's second largest equity market? Ben.
Yeah, it's amazing that we haven't really gotten traction there, right? Even the start of this year. And I was tracking the PBOC's liquidity quite closely, and they have been injecting quite a bit, even into year end. And I think that is yet to be coming back to the Chinese markets. Maybe it's really that the domestic base there is very cautious on that. We just haven't seen the economy really take off that everybody expected, including me. I thought that you would see somewhat similar reopening effect, but it has never fully materialized. I think really because people's trust and caution in the economy and everything that's happened there during the shutdowns, that's just not enough spending, not enough momentum there, and the manufacturing sector is struggling. On the other hand, China, as much as it is challenging for investors to gauge on what the Chinese policy will be as it relates to technology, for example, or internet or media, they are undervalued, right? I mean, the economy is a strong economy, so stocks are undervalued there. So I do think that people are right, taking note of it in the wake of the rally from last year.
Ben, Happy New Year. Nice to talk with you again. Ben Emmons there, Senior PM, Head of FI and Macro Strategy at New Edge Wealth. Just ahead here, and Ben was mentioning there are tensions in the Middle East. We'll get more on the story and fears of a wider conflict in the region after blasts in Iran killed almost 100 people. We have details coming up. Counting down to the open of trade, the Thursday session in Shanghai, in Shenzhen, and here in Hong Kong. Futures are flat, 60 minutes. Right, we're back below the 710 handle on the reference rate, excuse me, for the day. There you go with the offshore rates. We're looking at still quite a sizable difference. Now, the pivot out of HSBC, at least as far as they see, is really a move away from stabilizing the currency more to a more pro-growth tilt. More on that, of course, later on. Let's pivot now to what happened in the other big story we're tracking. In the Middle East, explosions in central Iran have killed almost 100 people who had gathered near the tomb of a former military commander. Now, Tehran says the attacks were aimed at punishing its stance against Israel. The U.S. State Department says it has no reason to believe Israel was involved. It's the latest sign that the war between Israel and Hamas risks widening into a broader conflict. Now, as to how energy markets did respond, we're seeing oil continuing to gain today, and of course Chinese oil in Shanghai continuing to do the catch up. They're up over 1% on that contract. Let's bring in Stephen Stapczynski, our energy reporter out of Singapore. Unsurprising, Stephen, we're getting this pop in oil prices.
Yeah, I mean, there is this, of course, tension in the Middle East, and you are seeing prices rise. Of course, you're not seeing oil jumping back to $100 levels. Brent is in the $70 range. But as one analyst said, no one wants to be short oil when you're in that $70 range, especially if there is tension in the Middle East. So while it's not clear exactly what's happening in Iran, there is some fear that it could spill into the Red Sea, further disrupting trade flows there. And then, of course, what's happening in Libya, with their biggest oil field now offline because of protests. It's just 300,000 barrels a day in a market that produces millions of barrels. It's not a huge amount, but still that does cause some fear about tightening going forward.
Well, that takes us into the outlook for 2024. You mentioned maybe two things we should be watching: geopolitics and supply and demand. What does 2024 look like?
So 2024, let's take a step back away from the events of just the last 24 hours. 2024 is looking bearish, right? There is a lot of supply coming online from non-OPEC plus members. That's the United States, that's the North Sea. I'm sorry, that's the United States, North Sea. Their production that is remained resilient from shale fields, that no matter how much Saudi Arabia cuts, or no matter how much other producers in the OPEC plus alliance cut, it's proving that their ability to push prices up, or at least put a floor in prices, hasn't been as effective as they've had in the past. OPEC has, in a way, lost their ability to control the oil market like they had decades ago, because there's just so much supply elsewhere. And because of that supply and relatively weak demand seen for the year, especially out of countries like China, which is the biggest importer, we're looking at more of a bearish year compared to the previous two, which, because of war and conflict, had sent prices, surging to pretty high levels.
Stephen Stapczynski, our energy reporter in Singapore, for us. Right, looking ahead to the opening bell, just over 10 minutes away. Futures are now, flat if you look at the two and you net the two out. Slightly stronger now on the Chinese currency following the fix. We have some data coming through, of course, out of Hong Kong and out of mainland China today. A preview of the trading day and those numbers ahead. This is Bloomberg. All right, a check of equity markets. You have Japan standing out. It's trading for the first time, so there's an element of catch down there. Plus, of course, what's been happening in the twin tragedies over in Tokyo. All things equal, we're down a third day on the regional benchmark. Looking at perhaps what to expect as we look at 2024 and the year ahead here, investors may be able, at least in Asia, may be able to expect a boost this year. You have rate cuts, you have a weaker dollar, but it's unlikely, though, that the catalyst, at least coming out of China, will ultimately determine the region's performance. Let's bring in our Asia stocks reporter, Ishika Mukherjee. She's with us out of Singapore. You guys have put out this really good piece, Ishika, on the year ahead. Just take us through the big factors we're tracking that might affect performance this part of the world.
Hey, Dave. Yeah, as you mentioned, the biggest one is China. It was such a drag on Asia last year, even when other indexes, other markets did so well. I'm thinking India, South Korea, Taiwan. This year, China remains the big trump card for the region in terms of any outperformance if there's a reversal trade there. Of course, bears abound at this stage, and it's not looking good for the market yet. If you just look at this first week of trading, the economy continues to be in the doldrums. Deflation is a risk. The property sector is a risk. There are risks wherever you look. The other factors that we're watching in Asia are the BOJ pivot, which could be a big one and could boost the yen, which is bad for exporters in Japan who are heavyweights on the benchmarks, the stock benchmarks. We're also watching for the Fed pivot. You had the minutes out, but the market's actually paying some attention to the minutes this time, unlike the last few times. And you have India, which is an amazing ex-China bet for a lot of foreign investors.
What other things? Elections are, that's a big theme too. Of course, we're starting things off with Taiwan in a few weeks. The U.S. elections to maybe bookend this year. Well, what does geopolitics look like, Ishika?
Yep, absolutely. So we're going to see elections in big markets in the region: India, Indonesia, South Korea, and Taiwan. Of course, the outcome of the election in Taiwan will determine the shape of U.S.-China geopolitical ties and Taiwan's ties, of course, with these countries going forward. In India and Indonesia, it looks like investors are betting that these growth-oriented policies of the incumbent governments will continue. In India, Prime Minister Narendra Modi is expected to bag another term, and that would just mean that if the market is it means the market is underpricing this risk, because if he doesn't get re-elected, Jeffrey sees a correction of more than 25% in the market, in the Indian market. And in South Korea, the incumbents are, of course, trying their best to get retail investor attention at this point. I'm thinking the short-selling ban, the president's decision, or pledge rather, to scrap a planned capital gains tax. So lots going on the election risk front this year for Asia investors.
There you go. 3.5 minutes. We literally covered everything in the region. Thank you so much. Great stuff there from Ishika and her team. Ishika Mukherjee, our Asia stocks reporter in Singapore for us. Futures pointing to now maybe a higher open slightly. You're getting some move higher in Chinese tech. Maybe that's lifting some of these contracts off lows. Just a couple of minutes ago, you had red on your screens on that. Shanghai crude, unsurprisingly, playing catch up there, 1.7%. So within that, the energy conversation, we're looking at the big oil plays in China. So you have the likes of the CNOOCs of the world, Sinopec, Shenhua Energy. Analyst actions, some changes, in fact, from the big brokerages today. So you have Citi coming out, JP Morgan with new Beijing Tongrentang, just a Chinese TCM, traditional Chinese medicine and healthcare play there. Race to buy at Citi. Price target is 65 renminbi. A stock, Jinko Solar, rated new underperformance quarry there. Flip the boards, please, very, very quickly. The agenda today, we're also looking at chip and laser-related stocks here, as the Chinese premier, based on the Xinhua report, is actually visited some of these chip and laser firms in Wuhan. Falling HIBOR, that's been a consistent theme so far. I think we're down almost, 80 basis points on the 1 month from the peak. And some data coming through in the form of Taishin numbers in about 20 minutes from now. I mentioned oil plays. We're seeing gains there. We're seeing gains in tech. Plenty more ahead, including the open.
I think China has some profound challenges on demographics. It has profound challenges in terms of building a consumption economy. There's still an export savings-driven economy. But on the other hand, China's 1.4 billion people, second largest economy in the world in gross domestic product. It's a key factor in global economic health.
To say the least, out of the executive chairman there, former CEO James Gorman of Morgan Stanley, on the challenges as we look ahead to hopefully a recovery in the Chinese economy this year. And certainly that also applies maybe to markets which have been bobbing around the bottom for the better part of the last 2 years. That bottom, of course, has also been lower than that floor. Here's the open for you today. We're looking at a little bit of weakness coming through. The PBOC coming out and draining some liquidity today, 60 billion renminbi here. Open market operations. Hang Seng is flat. That being said, this actually isn't such a bad open given the down drift we're seeing across other markets in the region. And of course, Japan is playing a big part of that. Pulling down the overall benchmark. The HSI VIX index is up slightly, which might indicate some risk aversion. Yields are pushing lower across the curve, 1, 10, and 30. Shanghai crude, that's a big part of the conversation today following the tensions in the Middle East. You have, of course, the tragedy in Iran and the explosions there. Nearly 100 people have died. What's still happening in the Red Sea, and now supply disruptions over in Libya, pushing up energy prices today. Flip the boards, please. Across sectors, this is what we're looking at. Financials are down. Industrials. You have some of the consumption plays. So the two green tiles on your screens are perhaps indicative of the move in tech specifically, because you have that sort of populating those two sector groups there. Dollar China, 715.46. So early stability. First few minutes of trade. We still could see, though, a third day of declines on this Chinese equity market, alongside, of course, the third day of losses in the Asia Pacific. Let's have a look at what's happened in these first few days of 2024 and maybe what the rest of the year holds for investors. Catherine Young, Investment Director, Fidelity International. She's with us here on set. Nice to see you. Good morning.
Nice to see you.
It's not a good start to the year.
It's not the best, is it?
Yeah. What's happening?
I think there's still a lot of confusion, people pricing a lot of expectations, let's say from a policy perspective, a lot of question marks over the Chinese recovery still. So I think it feels like we're treading water, not drowning, but still treading water and just waiting for some kind of move in one direction.
Outlook 2024. Let's start with Asian equities as a whole.
I think it's going to be challenging. I don't think we're going to see a broad-based recovery. We've got a lot of elections.
Yeah.
The macro data is still very, very mixed. I still think, I know I'm very alone in this space, but I still think China does look like it is an attractive market. I mean, a lot of people have discussed the challenges. The risks are so well known. Again, it's not going to be a broad-based recovery, but from a company-specific perspective, there are a number of opportunities. So, if you had to say which market is likely to outperform this year, I still think it's going to be Chinese equities.
Okay. On an index level, you think?
On an index level too, just because it is just so incredibly cheap. So unless the whole thesis around China is completely destroyed and void now, so many companies are trading at such cheap valuations.
The people that you speak with, I mean, cheap valuations has been a reality. We've been contending with anyway for the better part of the last 2 years. Do you get a sense that people are softening up? Foreign investors are softening up their stance on China, exposure to China?
It felt a little bit that in terms of sentiment was somewhat incrementally improving towards the end of last year, but the jury's out at the start of this year.
Okay.
So I think what's key for China is to continue to implement policy in terms of supporting measures, whether it's got to do with property, really being very transparent about any outstanding debt. But the companies that we're finding very attractive, I mean, they have pricing power, their earnings visibility is there. So even in this kind of challenging market where confidence is still a bit mixed, they're still doing well. And so if we do see a market recovery or an economic recovery, they'll continue to do well.
The old adage of, align your Chinese equity exposure to policy priorities, how does that look like right now? What sectors would you like going into this year? Well,
time and time again, there's this reiteration about being innovative when it comes to China, high tech, biotech. So all those areas are very, very interesting. Another new area, which, very fascinating, people don't talk about it so much, is agriculture.
Oh.
Yeah, so because, again, there's this big focus policy-wise on the agricultural sector. And let's face it, with the consumer, whilst the data is mixed, you're still seeing households being very well off relative to other households around the region.
Right.
And so it's just that level of confidence that needs to pick up. And again, this is really going to be driven probably by confidence in the property market.
What about regulatory risk? And we had a reminder of that before Christmas with that, the draft rules on gaming, and then they reversed course, and then you had a report that the person got fired. I guess the bigger question there is, do investors in China still need to are they still faced with significant regulatory risk? Is that premium still baked in?
I think you have to factor it in. And we've always said that policy direction, policy implementation is really, really crucial. It can benefit companies. It can also, sort of stop or prevent margins growing for companies. In terms of the regulatory risk, we're probably past the peak. So again, it's all about just monitoring the consistency and alignment of the policies and the messaging around those policies.
And you don't think there's enough clarity at this point in time, or full the clarity that investors need at least? We haven't gotten to that point yet.
It's definitely improved. And again,
Okay.
there's this increase in sort of coordination. We just need to see more and more of that.
Broadening out the view, one of the big winners last year was Japan. I think right now it's reopening. We reopened lower on the topic. I think we've reversed losses. Can we show that graphic, guys, if we can? Well, what's the 2024 story in Japan? That's up 25-30%, this index last year.
So, the macro story is still a bit mixed. So we talk about the consumer confidence levels in China being a bit dire. And we're not seeing stellar consumer confidence in Japan. And in fact, a lot of tourism is benefiting those Japanese numbers. So the data's still mixed. We still don't know what the BOJ is going to do. But from a corporate perspective, that positive trend we saw last year in terms terms of minority shareholders being rewarded by companies, that's likely to continue. Now, last year was very much underpinned by large cap value stocks in Japan. So if you look at the opportunities, whether it's in small cap, turnaround areas, semi companies who export to China, but their valuations are so low because they're just a beneficiary of China. And then just from a sort of a more recognizable perspective, Japanese food and beverage companies are gaining traction with overseas consumers and demand, and their brands becoming well known. This is what the Chinese companies are also doing, whether it's consumer or industrial, in terms of diversifying not just the domestic demand story, but also the offshore demand.
Right. And do you think investors will need to, I guess you mentioned small caps there, do we need to look further down that market cap table in Japan for the winners? Because it was really the large caps last year that, I guess in many ways, the exporters that led this rally. Definitely.
When we look at sort of those Japanese small caps or even in the unlisted space, a lot of interesting tech names are coming through.
Okay.
And don't forget, the penetration of technology in Japan is still very low versus, let's say, China, India, across the region. And so you've got the potential pickup in demand as well as that supply side. So some really, really interesting opportunities in that space.
Final question. Anything else we've missed? As you look ahead, is there a risk that we know is a risk but know not enough about that you think might just catch us blindsided this year?
I think we all need to be very mindful of the policy direction, not just when it comes to China or Japan, but across, everywhere. And it's not just about the rhetoric, it's actually the underlying data. But throughout this, again, it goes back to the company fundamentals and those companies that can survive and actually grow their market share and deliver to shareholders as we continue to see a rally or a recovery.
Catherine, it's nice to see you.
Good to see you.
Have a fabulous one. Catherine Young, Investment Director at Fidelity International. Okay, there are a lot of stories out of China today, and some stories we're tracking right now. Get you guys up to speed here. So LGFVs. Okay, so what does that story look like this year? So a lot of these vehicles may need to pay back, in fact, a record amount. There's a record amount of maturing local bonds this year, and that's set to test, of course, the limits of a central government program to help refinance their debt and avoid default. China LGFVs have $651 billion worth of bonds due over the next 12 months, and that's according to data compiled by us. That's the highest amount on record and roughly 13% more than what came due in 2023. Now, China says its Navy and Air Force conducted patrols in the South China Sea. Now, the event comes as the U.S. and the Philippines are holding maritime drills in the region. China's military says that the routine operations aim to resolutely safeguard China's sovereignty, security, and maritime rights, and also interests. Now, wages offered to workers in China's major cities have declined by the most on record. Data from online recruitment platform Zhaopin showed that average salaries for new hires in the fourth quarter fell 1.3%, and 1.3% in the greater context of things is the biggest drop since at least 2016, underscoring deflationary pressures and sluggish consumer confidence. Now, we gave you a little bit of a taste from our exclusive conversation with the Morgan Stanley Executive Chairman and former CEO earlier on. Let's continue the conversation. There's the U.S. financial system, he says, is in good shape and good health, despite several lenders collapsing last year. James Gorman also told us exclusively that the proposed new banking regulations are too harsh and are likely to change before being put in place.
There have been thousands of comments put into the various regulatory bodies led by the Fed. It was a proposal that I would say was extremely aggressive and set a marker. It will not go through in that form. If it did, I think it would have very, very negative consequences for corporate lending across this country, which is not what you want. It's not going to help the economy grow.
If the Republicans take the White House in 2024, whether it's Donald Trump or another contender, do you expect that this tighter regulatory environment will just fully unwind?
It's too hard to predict. I think we're in, you see pendulum swing, and we swung to lighter regulation to, I think, an excessive proposal. I think it'll swing back. So it's heading back to more balanced regulation. And that's where it should be. I'm all about balance. The banking system should not be deregulated. That would be a nightmare. On the other hand, if you overregulate and you require capital standards that are so high that the banks are uninvestable, they can't grow. That doesn't serve communities well. You need prosperous, thriving banks to provide lending products for small businesses and consumers.
To the extent we're less than a year away from a spate of bank failures. To the extent that there are still fragilities in the financial system, what are they?
I don't think there were a spate of failures, honestly. I think there were 3 banks that got it wrong. I've said that publicly. They made choices that were the wrong choices. Wasn't complicated. They got washed up and cleaned up and folded into other banks, and you move on. This wasn't, people kept telling me we're having a banking crisis. I said, no, we're not. We had a crisis among 3 banks. It was a crisis for their shareholders and their employees. It's not a crisis for the market. The core banking system is in rude good health, to use a British expression.
Well, you know, it's not just the banking system. If you think about the hedge fund industry, regulators are also very concerned about some fragilities there. It wasn't too long ago that Morgan Stanley lost almost $1 billion in the wake of the collapse of Archegos. Do you think that there needs to be more safeguards on the non-bank system?
I mean, there's too many participants in the non-bank system to say yes or no. You'd have to go subset by subset. Are we talking about payments? Are we talking about private credit? Are we go through each of the pieces of it? But there are always risks when you're dealing with leverage in a financial system. But if you don't have leverage, you don't have lending. So it's a balance. Again, I'm always back to there is a balanced solution to most of these debates, and you can find it with thoughtful discussion with regulators.
Speaking of
James Gorman there and our colleague Shanali Basak. Right, there's plenty more ahead. An update on these markets 12 minutes into the session. Asia market is at session low, 0.6%. More in the market action is just ahead. This is Bloomberg. Right, you're back with us. Obviously, Amazon, look out. Bloomberg has learned that TikTok is taking aim at growing its size of its U.S. e-commerce business tenfold to as much as $17.5 billion in sales this year. Let's get the details now from Zhiping Huang, our tech reporter who has this. So what exactly is TikTok trying to achieve here?
Yeah, so we know the concept of live stream shopping or social commerce has been the big thing in Chinese apps like Douyin, Taobao, or Xiaohongshu.
Yep.
So what Biden's trying to do over the past few years is to really export that e-commerce model to elsewhere, the world globally, beyond China. So for context, last year, TikTok was on track to hit $20 billion in GMV for its TikTok Shop feature. But large of that volume was contributed by Southeast Asia. So what TikTok is trying to do this year is to really take a crack at its biggest market, that is US, and also compete with the likes of Amazon and Chinese apps like Shein and Temu.
Well, given the cutback in ByteDance on gaming at the end of last year, I mean, how can we read into that as far as the growth trajectory and strategy are concerned?
I think for China tech in general, the big theme over the past year is cost cuts, to really focus on your strengths and get rid of the risky bets. So Biden's retreated in game development. Yes, it's a more riskier business for it. So what Biden's is trying to do is TikTok and Douyin are its biggest assets. So it's really trying to beef up the features and offerings within those two video apps and turn it sort of into a super app. So TikTok is adding more features like live stream shopping, and Douyin is becoming more like WeChat as a super app to 1 billion Chinese people.
Yeah, they're all coming together, aren't they? Eating into each other. Zhiping, fantastic stuff. Zhiping Huang, our tech reporter. You can read all about that scoop, of course, on the Bloomberg terminal and also on the website. Right, some breaking news to tell you about Caixin numbers, composite and services perhaps more material at this point in time. Massive beat, consistent with really the manufacturing iteration of the story. So at 52.6, that's composite. Let's get the services up, please, if we can. 52.9, I believe, was the, let me just recap, let me just look at my data here as well. On services, 52.6, is that 11? 52.9, okay, my mistake, there we go. Highest since July of this year, and it came in above every single estimate from economists there, though. That being said, I should also caveat this by saying that there are only 3 estimates out there. So, okay, there we go. Good set of numbers. out of the Taishan version of PMIs. Okay, now let's take a look at our big take today on China. This Bloomberg investigation has found that U.S. and European banks are ring-fencing their operations in China on a scale that's rarely seen in modern international finance. Let's take a closer look at the story with one of our reporters, of course, our China Tech reporter, Sarah Zhang, who's been really having a closer look at this. So first, fantastic piece. What's been behind this ring-fencing activity?
So I guess what we're seeing is U.S. and European banks increasingly move to ring-fence their operations in China, like you said, and that's driven by a series of factors, the most imminent of which are these cross-border data transfer rules in China. And what that means is that there are more restrictions governing the kinds of data that can be transferred out of the country and how that process is carried out. So on top of other factors like the slowing Chinese economy, increasing geopolitical risk between the U.S. and China, that's creating a situation where these banking subsidiaries in China are increasingly operating more independently from their global headquarters.
Yeah, tell us about the how. What other measures? So what does ring fencing mean?
So it's quite a complex and costly process. It means that these companies are having to set up onshore data centers and on-site internal controls in China for a lot of their financial data, internal company data. And that's why we saw, for example, Citigroup, they had to delay the setup of their wholly owned securities business in China because of how complex and technically challenging this process is. It's also why we've seen, for example, One Wall Street Bank even stopped briefing their China head on some internal company strategy because of the data security concerns.
And while it doesn't look like this changes the bank's commitment to China. In fact, it might actually say the opposite. They're putting more resources into the China operation. Does this change the future, though, and growth trajectory of these Western banks in China?
I guess the fact is that all of these companies are having to navigate growing costs of doing business, growing costs of compliance to be in China. They still want a piece of the China market, and they're still willing to find solutions to navigate this. But what it means is that in the future, for example, global banking subsidiaries might have less room to navigate risk and to maneuver if they have to, make hedging positions locally, for example. So it's making it more difficult, but they still want to stay there for now.
Fantastic. Sarah Zhang on today's Big Take. Right, there's plenty more ahead, including we'll take a look and give you a recap of all the data coming through. You have PMIs out of Singapore, Hong Kong as well, and we'll preview the retail sales figure that's coming out of Hong Kong later today. So suffice to say, there is still plenty more ahead. This is Bloomberg. Relatively busy day as far as Hong Kong economic data. So we'll give you guys a preview, and you're looking at that on your screens right now. So retail sales are coming up. Before I get to that, though, we did get PMI numbers about just over an hour back, and really coming in nice. So we're coming off a 48.9 read. We actually coming in at 51.3. So that's not actually a bad print out of Hong Kong. Can we go to that chart again if we can, please, as well? So just broader context of things, right? 11% is what we're expecting the increase to be for that specific month that's coming out today. And broadly speaking, we're actually on track for a recovery in the next several months. We're already about 90% of the way up if you compare the 2023 average to the 10-year average before the pandemic hit, right? So that's, I guess in many ways speaks to the aggregate picture. Now, looking more granularly, just having a look at the data here, for example, things like jewelry and watches, for example, haven't quite recovered as quickly as the entire industry. We're only about 60-70% of the way, whereas this is, of course, 90% of the way. Anyway, we'll get an update on that, of course, towards the end of the market session today. Right, brief look at markets, and the story, in fact, is crossing the Bloomberg terminal right now. So Chinese banks are scrapping business class flights, and that's in an effort here to control their costs. Some national lenders have also cut hotel budgets for largest Chinese cities, as banks are facing pressure, of course, from the government's call for common prosperity. Airlines are down, as you can see on your screens. Flip the boards, please, and have a look at where we are across the Asian equity complex. And we're down about 1/10%. A lot of that is Japan, which, by the way, is coming off lows as well as we speak. S&P futures are up 1/10%. We're still contending with a stronger dollar, which is why perhaps a lot of the bulls are still sitting this one out. We've been tracking also this rally in CGBs of late, so we did get a pause, 2 days. It's been consistent, though, since late December. In fact, the 10-year yield is now broken below the trough that we hit back of last year, and now back to levels of April 2020. What happened in April 2020? That was the depths, of course, of the pandemic when that first hit. And at 254, generally speaking, that takes us back to about those levels as well. So, yeah, more on that in a bit. Plus, of course, the weakness coming through in the Chinese equity market will leave you with what I imagine is a beautiful but winter, very cold morning in Shanghai. There you go in Lujia's way. Markets are on offer. Caixin services out. Bottom of your screens. Plenty more ahead. This is Bloomberg.